Hello, viewers. Thanks for tuning in to Alpha Moguls, a show where we speak to some of the finest investing minds about what is it that they are seeing around the current investment climate and how is it that they are looking to build their portfolio to tide over the next 12 to 24 to 36 months. This is the first episode of this current season, and I'm pleased to have the two stalwarts of Girik Capital, Charandeep Singh and Varun Daga, joining us, one from Mumbai and one from Goa. Before we get into the show, Varun, I'm tempted to ask you, Mumbai, it's pouring. What about Goa? How is it?
Goa is lovely. It's green. It rains for a bit and then it opens up. So it's beautiful here.
Okay, great. Okay, gentlemen, thanks so much, of course, for joining us on Alpha Moguls. And may I request the two of you to tell us a bit about Girik Capital? What kind of firm you are? What is the ethos of how do you go out and invest your what is your investing style? A bit about yourselves.
Yes, of course. Thank you, Neeraj. First of all, I'll just quickly open this with a quick word of thanks to you for having us on the first episode of Alpha Moguls. It's a great show, and we're really proud to be part of this series. And also, thank you to the Alpha Moguls production team. Thank you to BloombergQuint. Really happy to be here. Like I said, really excited. Quickly to talk about Girik Capital, a very brief background. We started this journey in 2009. It's been a little over 10 years now. So, we are a firm, as I call it, we're a two-cycle firm now. We've been through 10 to 11 years of track record, and we've seen the two very large economic cycles. One was the politically linked economic cycle of 2010 to 2014. And of course, now, 2018 to now, you had this whole small and micro cap cycle with the decimation in equity prices, even in large caps due to COVID. So I think, as we have completed, I wouldn't say the cycle is complete, but yes, we've been through two large severe cycles and we weathered the storm pretty well. I'm very happy to share with your viewers and yourself that in a recent study conducted by an independent agency that tracks all PMS and AIFs, it's called PMS AIF World, we were the #1 performer in the country in the 10-year returns category. So, I just wanted to say congrats and thanks to all our investors on behalf of all of Girik employees. I think it's a great milestone and superb validation for us. One more thing I'd like to say is that even after 10 years, the entire Girik team is just as excited to deliver for our investors as we were when we started this journey. I think things are even more exciting. Things that have happened in the last couple of years make equity investing challenging, but much more fun, I can tell you. On that note, maybe I'll let Varun introduce the Girik Multi-Cap Growth Equity Strategy, which was inspired by William O'Neill's CanSlim style of management, which is something we are still very inspired by.
Thank you, Charandeep. So we started this strategy in 2009. I would just want to tell you how Charandeep and I met. So I was managing some money for my family, and I met Charandeep's dad first, and he himself was a great investor, and he gave me some money to manage, and I was using this style inspired by William O'Neill called CanSlim. And when he made Charandeep meet me, in first meeting we decided we should use this style and start a fund, and that's how Girik started. And we never looked back. In this 10 years of Girik's journey, we have an investor who's invested with us. The money is up about 6.5 times versus Nifty, which is about doubled itself. So, and that's post fees and all expenses. So we're very proud and excited for our next leg of growth. We've never really gone out and marketed ourselves too much. Our whole focus was on performance, and we're really excited for our next leg of growth. And our processes, our systems, we feel we worked a lot on that. Our risk management, in fact, in every fall of Nifty, we've managed to fall less than the index over the last 10 years. So, we're pretty excited, and I hope we remain humble and we take the next journey as we did in the last 10 years.
Okay, viewers, I understand Varun's feed is slightly unstable, but well, he's in green Goa, so that can be expected. We'll try and hopefully get as the show moves along, maybe a better video quality as well. But Varun's audio was completely clear, so I'm guessing we can take some inferences from the answers that he's giving. But okay, let me try and ask this to you. You guys said a lot about the processes that you've put into place, and I heard Charandeep speak about canceling approach of William O'Neill. Can you tell us a bit about how do you go about picking your stocks, and has the strategy changed even a wee bit in the last 6 or 7 odd months? Charan, you want to come in? Yeah.
Let me start with that answer. I think very good question. I think that first of all, I would say that no, the strategy doesn't change. It's pretty much what we've been doing for the last decade. I just think that we aim to do it better with every passing month, right? So I think Girik is a lot about process and discipline. So, you asked about stock picking. I would say that, our stock picking is an extremely process-oriented exercise. We have a certain parameters that we follow in order to screen and find what are large potential winners. Then we put them through an intense and rigorous research process. So that's on the buying side. On the sell side, I'll tell you, that there is a lot of discipline around actually weeding out mistakes. I will, at a high level, tell you, and I'll let Varun get into some detail in this, is that the whole concept of weeding out investing errors is something that requires a lot of awareness and process, right? So this is traditional risk management. Most of your returns, a lot of your returns come from avoiding errors. One thing to find winners, having great process in buying discipline, finding winners, writing them, that's definitely one half of it. The other half, which we think we do just as well as any manager, is to make sure we make less mistakes. And if we make the mistakes, how do you identify and weed them out? So, traditionally, most investors or investment management firms, if they bought a stock at 100 rupees at a certain valuation, at 50 rupees, they'll go and average down. We don't do that, right? Alarm bells go off when our stock prices decline. We want to understand what's changed. So we take a little bit of leading indicator from the price and do even harder work to see, did we get the buy point wrong? Or did we not assume the growth correctly? Is there something missing? Is there more competition coming? So that, I would say, is the process and discipline that has kept us ahead of the street over the last decade. And I think we just do it much more intensely than we ever done. So maybe I can go into detail, a little more detail about the buying process, buying high, selling higher, stuff that is a very catchy word, but, it works for us.
So I would just add to that, I think a very integral part of it is risk management. So the whole, I would say that the whole secret to winning big in the stock market is not to be right all the time, but to lose the least amount when you're wrong. So I think that we take it very, very seriously. We weed out our losers very fast, and that makes all the difference in our investing style. And if you look at the index, even when you look at the index, Nifty, it weeds out its losers. Imagine if you had Nifty with Suzlon and Unitech and Reliance Communication, where would Nifty be? So we follow a similar process. We weed out our losers and we add to our winners. How do we really screen? So I think one of the important part of how we find our winners is in our screening process.
Varun, sorry, I just want to come in and just, because a lot of participants are joining as I speak. So I just want to alert people, viewers, I understand that the feed is slightly unstable, but if we can take the leaf out of the answer that Varun Daga is giving, it will help all of us as well. Yeah, sorry, Varun, carry on.
Sure. I'm sorry about that.
No, nothing can be done about it.
Here.
That's okay. Yeah, please carry on. You were talking about the process that you follow. Varun. Please carry on.
Sure. So, what differentiates us is when we screen through, we look at price as a very leading indicator. So, what usually most of the investors do is they look at price and they try to find value at a 52-week low. We actually believe that we can find value at a 52-week high. So people tend to, think that value is price. So we actually believe that this is the wrong notion. Value is value and price is price. You can find value anywhere. You can find value at a low or you can find value at a high. We believe that we could a lot of value can be found at a new high, because some of these companies are run by very good management. They are run by they have leading products, they are leading companies. So we are in that basket where we do not try to bottom fish a loser. On the other hand, we would look for a winner where the earnings are accelerating, where the leadership is very well established, where the management is really superior. And that's where we will try to do our fundamental analysis rather than going into a loser.
So I have a follow up there, Varun, and either Varun or Charan, whoever. But if you try to fish in that pond, the comfort of valuation, and I heard you mention that value is value and price is price, but the comfort of valuation discount or growth at a reasonable price doesn't come around, right? Most often than not. So then, therefore, do you do a large portion of your purchases when the market falls, give you an opportunity, because at that point of time almost everything comes down? Or are you comfortable buying companies even at higher valuations because you see growth coming ahead? What happens generally?
So let me start with this, and then Charandeep can add. We did a lot of analysis on this, and one of the, and this is like bursting a myth, that all of us look at PE ratios as one of the leading ratios to value a company. We, with all our last 10 years of study, we've seen that PE ratio is one of the most misused and misunderstood number, and actually it has very little to do with the stock's performance. In fact, one of the most of the leading or most of the leaders of the past decade or 2 decades, before their biggest move, they have been expensive. So more than P ratios or valuation, what's more important is how the company's growth can accelerate in the future. So we truly believe that growth is more important than the PE multiple, and what the company can achieve over the next 3 to 5 years. That's way more important, because when that growth comes, in hindsight, it will look very cheap. And we've seen that with many companies. Look at D-Mart or Bajaj Finance. Some of these companies were expensive always. And after becoming, and look at Bajaj Finance, for example, it was expensive in 2010, 12, 15, 18, and in FY20, everybody wanted to own it. So after becoming a 100-bagger. So the point is that the biggest winners could be expensive, but what one has to understand is their leadership and what lies ahead.
Okay.
I think I'd just like to continue with one more point. I think anecdotal evidence, is or rather giving examples to sort of explain this thesis that we are sort of laying out. You look at DMart as another example. I could swear to you, when the IPO was out, everybody wrote it off as really expensive. Everyone said, "Bahut mehenga hai." The P, the first thing people look at P 60 times, 70 times. What people failed to look at was the leadership in the franchise. At whatever price the IPO was, I don't remember, 300, 400, 500. It was very hard to make a case for most managers or most investors. But, as time passed and the stock price went up and people got more and more comfortable with it, there was much more comfort in buying it, So, I would say that it's very important to really assess leadership and runway to growth. So DMart at the time of the IPO, if a manager could successfully assess that, look, really leading franchise, very good 5, 7, 10-year runway to growth, very clear. And 3 years down the line, 4 years down the line, the earnings tripled. So you weren't really paying that higher price if you could forecast the earnings or if you had a grip on the leadership of the company. That's what we're attempting.
Okay. A follow-up, Charandeep. That is, and again, viewers, keep in mind, we are using these as examples. We do not know, and I would urge the guest also not to speak about whether they intend to buy, sell, or hold any of these examples that they're giving. But here's my question. Uh, on hindsight, yes, an IPO investment into a DMart or a Bajaj Finance at whatever price it was in 2018, 2019 seems good. My question is, um, at Bajaj Finance, when they did the QIP at 4,100 or 4,200 or thereabouts, wherever it was trading at about 9 times price to book. And it certainly seemed like the growth is there. My question is, how do you discern whether uh, a 9 times price to book is expensive or a 6 times price to book is expensive? Because there are companies which at 6 times price to book, you buy them and then they correct. And there are companies like Bajaj Finance, for example, you buy them at 8 times price to book and actually it moves up as well. So when you invest, how do you kind of decide between these parameters? What is, even in the expensive parlance, what is like egregiously expensive and what is not egregiously expensive but relatively expensive?
I'll just come in here very quickly. Then Varun can add. My personal experience. You brought in Bajaj Finance, which is probably the best example that you could bring, because everybody was caught with, for the lack of a better word, with their pants down. Frankly, excuse my language, but
Yeah.
January, February, March, things were so hot. Now you look at Bajaj Finance's. Let's put two buckets here. There's Bajaj Finance and there's the entire financials weightage in the index. The weightage of the financial services sector in the Nifty had gone up to as high as 44%, 42 or 44. I'm not sure. Something like that in January or February, before pre-COVID hit. So, if you look at the one thing that raised our eyebrows and alarm bells as early as last year was how everybody was buying financials and getting comfortable with the growth, the 20, 15, 30% growth across all the banks. ICICI was coming back, Axis was coming back, HDFC would continue forever. Bajaj Finance growth. Bajaj Finance across most PMSs had become a 10, 12, 14% holding. In the index, it was a 2% holding. You have to watch out for all these things. Sell signals are very subtle. No one's going to come and tell you that the earnings are going to... Hell, nobody can forecast it. I think one of my favorite dialogues in the market is nobody knows anything. Okay? The minute you tell yourself that you can't forecast and you're not a good forecaster, you won half the battle. Don't try to forecast. Build process, build discipline. We can get it wrong. We also got some of Bajaj Finance wrong, by the way.
Sure.
We also made an investment mistake. We had some holding. But you know what? Our process and our discipline got us out of it. And we had downweighted the financials very early because we were very uncomfortable with the consensus. We were very uncomfortable with the ease of buying financials and owning. And the fact that they were so overweight. India, for hell, had become a bank Nifty index. And that worried us. So a lot of red flags. These are subtle things that we do on a weekly basis. These are soft anecdotes we put down on paper. And it's done in a very intense process-driven manner. So yes, what you can do is, as a manager, you may not get the Bajaj Finance exit perfectly, but what you do is, as a process, you start downweighting the sector. You start getting out of the weaker stocks. You ensure that you're not the last one holding it, and you have to be very, very cautious about these things. So I think it's a great example that you brought up. I'll let Varun add here because I'm sure he has a lot of things to say as well on this. But this was just my thought process personally over the last 1 year when it came to financials.
It's very interesting. Varun, do you want to supplement this?
Yeah, I would just say that yes, it's very important that we look where the consensus is going. There are times where everybody wants to chase one thing, and that's when we become it raises our eyebrows. So, and also what happens is that when a leading sector starts to fail, that gives us a sign that the whole market is beginning to change its shape. So we saw that happen in the early January, February, before the COVID, and we saw then the market itself turned itself. So I think the early selling is always tough, but the early indicators can give you some kind of heads up.
Okay. You guys want to dwell a bit upon this approach that you mentioned, the CanSlim approach. It's now gathered a bit of traction in the last maybe 12 to 24 odd months. But I think in some fashion that drives you to buy companies which might be higher in the belief that earnings growth will make these companies go even higher and then you can sell. Do you want to spend a bit of a minute or two on that?
I'll let Varun take this. I think it would be better explained to him.
Sure. So, it's one of the greatest paradox in the market that, what seems too high usually goes higher and what seems too low usually goes lower. So it took us many years to understand that. that some of the stocks which are making highs in a bad market could have a lot of steam in it, and that is one place where when we focus and when we open the fundamentals, we find that there's so much going on in those companies, and they're probably at one of the cheapest level they have been in the history of those stocks. So I think we just don't buy high for the sake of it. We actually follow it up with a lot of rigor, with a lot of fundamentals, and that's when we realize that, okay, if a stock is making a new high in such a bad market, then probably the smartest money is chasing it, right? So that's when we follow an indicator called relative strength, which we feel is a very, very important indicator. It is the relative strength of the price compared to the overall market. So for example, if the Nifty falls 30%, and in the same period, if a stock is down only probably 5%, we would go and look at that stock to see what is that fundamental factor that could work in the favor of that stock. So I would say that relative strength plays a very important role. The other thing is the industry. So we caught on to pharma quite early because that was one sector which was outperforming even while the COVID hit. And many people thought that it is just because because of it's the safety trade. But our system forced us to look at pharma, and when we started looking at them, we really saw some of the companies where earnings could accelerate in a big way. And that's what we are seeing now, because pharma had gone through a lot of consolidation over the last 3, 4, 5 years. And our system actually told us that go and look at that sector. And another thing which is very important in our system, why sector is very important, because our studies have shown that 50% of a stock's move is because of the sector it is in. So you could be in a great stock, but if the sector is not in favor and the overall strength is not good, and the overall the strength of the industry is not good, the demand is not good, then even the best of the stocks suffer. We saw that with something like a Sun Pharma. It was the darling of the market in 2015, and then everybody bought it at every fall, and then it fell like 60, 70, 80%. So every stock can fall when the sector goes bad. Every darling of the market can fall 60, 70%. So we believe that it's very important when we are managing public money to be in the right sector where there is tailwind, where there's earnings growth, and to stick to the leaders. So the third part is the leadership. So we truly believe we do not buy the second or the third or the fourth player. We try to buy the leader. We would pay for that leader, but we would stick to the leader. We will not just because of price, we will not compromise on the quality. So quality comes first for us, and of course we would want to buy it at a price where we know that we could make money, but we would not compromise on the quality of the company.
Okay, so 2 follow-ups to this. By the way, Charandeep, when I look at the post first quarter research reports that have come in, almost every sell side, or not every, but a lot of sell side reports suggest that the excitement around pharma and the kind of bump up that we've seen is overdone. Now, my question to you is, because you guys, if you invest in a space, are not investing for a quarter or 2 quarters, do you reckon that the runway of growth is long enough, and therefore you might be comfortable buying high because you see an opportunity of selling into these 2, 3, 5 years later, or whatever the time frame may be, higher from where they are right now?
Neeraj, I want to just add a little to your point.
Sure.
Add to what Varun said. It's very interesting that domestic pharma companies started coming up on our screen a year and a half ago. That's when we actually started buying them. We bought a couple of domestic pharma names, which we have now started taking some money off the table also. So, pharma is several buckets. There's a US angle to it. There's a backward integration angle to it. There's a domestic pharma angle to it. So it's not just one bucket, number one. I think one has to put a lot more work fundamentally before one can just call it pharma and brush it. So I think to the point that Varun made, really sticking with the leader with an earnings tailwind is very important, right? So we're going to stick with some of these that we have. We are trying to ensure that the price is enough. I mean, the valuation remains in our favor. There's enough money on the table for the next 5 years. Some of these may have run up so much that they're actually worth taking money off the table today, right? So we will rebalance, right? We have to keep the discipline and the process in place. You can't just go gangbuster. It's given you a 40% return in your portfolio, you're going to take some money off the table in a systematic manner, right? So that's one part of the answer. I think the other thing is that as long as the earnings momentum is coming and the leadership is intact, one thing we've learned is ride your winners. There may be consensus in the near term. They may do nothing for the next 6 to 9 months. Other sectors may temporarily. Financials may come back for the next 6 months. It's very important to be able to follow a process, which our process being, make sure you stick with the leaders and follow the earnings acceleration. As long as the company's earnings are growing in an unexpected manner, you stick with those stocks. Because what we saw, we got out, I'll tell you, the mistake that we made in the last cycle was we got all the winners early, right? I'll name some of them, the Bajajes, the Astras, we also got out of them, some of them early. If you had just stuck with them through earnings acceleration, that's where the real money is made. The multi-baggers come from sticking with companies that are growing their earnings, leaders that are growing their earnings. So, okay, if it doesn't do something for a year, but you will be able to hopefully see through that period and make many times your money 5-6 years down the line. At least that's the aim. In theory, it all works. You have to execute it week to week.
That's true. Charandeep, a follow-up. There are a lot of spaces that the leadership is not necessarily. There is not necessarily just one leader. I mean, specialty chemicals, for example, right? Certain companies are leaders in certain compounds. Certain companies are leaders in some other compounds. What happens in these spaces? Part one of my question is that, and part two of my question is there are a bunch of spaces which are necessarily, by the nature, not really large cap sectors. They are essentially comprised of mid-sized firms. Right. Do you guys take sizable bets on such teams as well?
So I think, again, it comes back to our portfolio construction mechanism. Number one, we can't really look at very illiquid stocks. We are sizable, So if something is not above a certain market cap threshold and is something that is not easily liquid or liquidly bought or sold in the market, we don't look at it. We are very cautious because we want to build liquid portfolios, right? That's number one. The second thing is that we are very balanced. So, in the event we do see some great leader in a niche specialty sector, which may be slightly illiquid, but we think that it is just an outstanding leader and has a great runway to growth, we will take a small position, So we have done that in the past and we will do that in the future. But again, it's small amounts because liquidity matters.
Liquidity matters. Okay. Varun, one quick point, and then of course I'll request all the participants, if they have questions, they can pose and I'll try and take some, because I have a bunch of questions for the next 15 minutes. But if indeed people have some questions, I'll try and take them. If they are not stock specific questions, of course. But Varun, just a quick question. The other part of your investment strategy, if I'm not wrong, is trying to do away with this notion that low PE means that the business is valuable. It works sometimes, it doesn't work. How do you differentiate?
So, I think it's the problem is that people start the screening process with the low PE. The most important thing to do is start your screening process with the business, with the promoters, with the quality of products. I think that is with the earnings, with the quality of earnings. I think if one starts the screening process from there and then goes and looks at the valuation. So what we do is we always look at valuation when we want to buy a stock. When we want to evaluate a stock, we do not look at valuation, because a great company will be a great company, whether it is expensive or it's cheap. So first you find a great company, right? And then whether that works in terms of your valuation parameter, that is secondary, right? So first, always look at whether the company is really great. Would you want to buy the whole company? Would you want to stick it for the next 5 years or 7 years? Even if you don't, but at least you want to get into that company with that horizon. And do you see that kind of acceleration in that company? What we have seen is this P ratio is a way to actually, a lot of people do not even reach to a great company because of the PE ratio. So it actually works as a hurdle to reaching to a great company. If you would have missed some of the biggest winners, if you started your diligence looking at the valuation, right, or looking at the PE multiple, because and we've seen that some of the greatest winners which we have picked, they always looked expensive to start with. But when we forecasted and when we looked what this company is capable of and how big it can get over the next 3 to 7 years or 5 years, we really believe that okay, the multiple really doesn't matter, because 5 years down the line, the P multiple itself will look very, very cheap.
Got it. Okay. Now there are a bunch of questions already. I'll try and ask some. Charandeep and Varun, if you cannot answer due to compliance reasons or just the processes that you follow, please feel free to tell me so on air. No problem. But first, a few questions which are fairly generic in nature. There is one from Dipesh Talal, and he's asking whether, I think he heard you say that you make some decisions of buying based on the relative strength basis. He's asking whether you also make sell decisions on a relative strength basis.
Yes, we definitely do that. There are times when the market is flying and going up and your stocks are not doing anything. Again, we go out and try to find out what that reason could be. And sometimes we realize that the runway of growth could be coming to an end. And that's when we take an exit call. Charandeep, you want to add to that?
No, that's perfect. I think that's well answered.
Okay. There is a question from Khush Gosrani, who's asking about how do you guys look at accounting measures and clean and good as reported numbers to reflect the true picture?
Yeah, that's a good question. Thank you. I think that is very important to look at cash flow generation. I think you have to look at the working capital cycle of a business. Unnecessarily long working capital cycles, poor inventory turns are a red flag. Another red flag is continuous capex, mindless capex, which is very different from the rest of the companies in the sector. And that all this gets mirrored in a low return on equity, right? So I think these are the things to look for. One last thing I'll say, companies that rely on external funding regularly are a major red flag and highly avoidable in public markets.
Interesting. So that would probably eliminate a lot of infrastructure stroke capital intensive businesses in your portfolios, gentlemen?
Okay, so the one sector that requires the most capital always, and which we say that's fine, financial services, because that's regulatory. Infrastructure again is such vast buckets, right? I think many infrastructure companies in India probably will go into REITs, the more stable ones, the more high quality ones, will probably go into REITs, become yield plays. The typical in India, definitely the sector has not necessarily added much value in the last decade. Also because of the lack of growth, also because serious payments problems from state governments, municipalities, central governments. I think all that needs to be sorted out before it becomes attractive for an equity investor. Otherwise, you don't know how long your holding period will be and you don't know if you'll get rewarded for that risk. So, Neeraj, your point is fair. It does eliminate those to a large extent, many of them.
Yeah, and viewers, keep in mind.
I would just add.
Yes, sure, Varun, please carry on.
I would add to that is we pay a lot of attention to corporate governance. Stuff like how much salary is the promoter taking, what kind of ESOPs are there, what have they done in the past, have they diverted money anywhere, and if we see, and luckily being a listed company, we have all the history. So if there is any corporate governance issue, which in India there are quite a few, we truly avoid that company.
Okay. Madan Pamidi is asking about the weightage that you give in identifying a great stock to various valuation parameters, price earnings, price to book, ROE, ROC, quarterly earnings, etc.
I'll let Varun take that maybe, especially the questions related to PE, and I can add to whatever he wants to say.
I think look, we do not give much weightage to the existing PE, because we believe that leaders will always surprise you. We give a lot of weightage to growth and the acceleration in growth. So what we believe that P multiples expand because of the growth, and P multiple contract because of the degrowth or because of the deceleration in earnings. So we give a lot of weightage to earnings acceleration, annual earning acceleration, quarterly earning acceleration, and of course the quality of company. But in terms of valuation, we do give a lot of weightage to earning acceleration. And of course, in terms of ratios, we definitely look at the stability of the ratios, the working capital management, the return on capital metrics, how is the ROC been, how is the ROE has been, and just not the current one, but across cycles. So we do look at last 10-year data, as much as data that is available, and we always try to go and see how the company has done in a bad cycle. So I think that gives us a lot of answers.
Okay. There's a question from Nilesh Thakkar asking about whether with the Atmanirbhar theme for defense and India being seen as the pharmacy for the world, do you think that defense and pharma are the next prominent sectors that will lead the index like banking and finance did earlier?
I think that it's very hard to say that. That's a very difficult question to answer right now. Like this whole defense theme, thematically, what's in the news is not necessarily what attracts us. So if I look at something like defense, I think it's very important to actually understand that, even 6 years ago, all this was talked about. You have flavors come up because of the news, because of some government reform. Let's wait. We'll see when it actually happens. It's too early to be preemptive. It doesn't really make sense to go out and put your money out or invest your money out like that in something that still is so unproven. So whereas the sector, second thing is the sector may do well, but maybe listed companies in the sector aren't there. Who knows? So so I would definitely not recommend anybody go out and take preemptive course of action because there's news out there on defense because of Atmanirbhar. Second thing in pharma, we are seeing genuine traction. I would say, so that's something more real for an investor. If you look at the government's focus, and they've genuinely put reform on the table in terms of giving drawbacks to companies that do capex for certain APIs or certain intermediates. So yes, there are opportunities there, and investors must look to those because that reform has been implemented. You have a large coterie of very, very high quality global standard promoters and management teams, both here in the sector. So I would say that the universe there is large. India is a global leader. There are several leading companies in India in the sector which have proven themselves over 15, 20 years. Rather than just focus on the Atmanirbhar theme, go out and find the best companies in the segment that you like, that have delivered over the last 15, 20 years, that have the right ingredients in place of leadership, management, governance, and yes, earnings growth. All those combined.
Okay. There's a question that is more stock specific. So I will not get into that same question from Aditya Podar, but if I can ask an offshoot of that question, like he's asking about why Bharti is not moving. Now, I just want to tie it up with a mention that you guys did earlier, that at times companies which are in a good space might move up and then consolidate for 3 to 6 months and then start moving again as well if the earnings potential for the next 4 or 5 years is there. So the question on telecom might actually fit in here, and if either of you has a view there as to it's a very small bucket, yes, but aside of that one company really making the moves, and that's probably not just because of telecom but because of a lot of other factors, how do you view this pocket which saw a lot of fanfare and has gone a bit quiet in the last quarter or so? Any thoughts?
I would say that, look, one must focus on the fundamentals here. The fundamentals of the sector are definitely improving. I mean, it's for all to see that you've come down over the last 10, 12 years from 25 competitors to 2, virtually, right? Naturally, pricing should come back. And if pricing comes back, i.e. ARPUs go up due to the lack of competition, also because of the increase in the amount of data we are using, you have pricing growth and you have volume growth. So what more do you want, right? So logically, it should all work out. What stock prices do remains to be seen, because only the price knows what the price does. But as far as the fundamentals are concerned, they seem pretty solid for the sector. That's my opinion. Varun's done a lot of work on the sector as well. Maybe he'd like to say something.
No, I think that's very true. Now you have a consolidated industry where the volumes are growing, the two players are taking the market share, and the pricing are also growing. And I mean, we all can see the amount of data we use. I mean, we cannot live without data. You can live without one of your arm, but you cannot live without data. So data is like the most important thing what we have right now. So clearly, we truly believe that there is a lot of tailwind in the sector, and of course, stock prices don't move one way, right? It'll it'll give you a lot of pain. It could give a lot of corrections, and eventually move up higher. We've seen that with many of the winners of the past, like stocks have corrected 30%. Before starting their next leg up. So you always have staircase kind of move where they go up, they correct, they move up again, and I mean that's what makes the stock market. It cannot be one way.
Okay, can I slip in a question here based on your earlier answer, wherein you guys mentioned that you and I'm not correlating. I'm not saying that you believe telecoms is a loser pack. If anything, you are saying to the contrary. But you did mention that if you buy something and if it corrects a bit, you don't average it down. I'm not saying telecom is corrected, but I'm just trying to use an example out here that let's say you bought something which is a promising sector for the next 5 years, and due to whatever reason, you paid a slightly higher price for it, and for a period of time, it is corrected both time and price wise. Would you stick to that idea because you have a conviction over 5 years, or because your policies that you do not average down, you will not do that? Let's say you had a very small allocation. Would you increase that allocation because the price fall is actually giving you an opportunity? Because it seems the most logical thing to do, but I don't know if you think otherwise.
All your tough questions, I'm going to make Varun answer.
Okay, so if the stock, I'll tell you, if the stock price has fallen from the price you have bought, that means you've done something wrong, right? I mean, something is, maybe your entry point was not right. So we would stay away from averaging it unless we have decided that at the point of entry that we would buy some more at these prices. So we do have a range in mind, which we always keep. But what we also do, for example, we bought something at 100. Now it's gone up to 200. So for us, it's already doubled. From 200, if it comes to 150, we could add at 150. So we use these little corrections to add, because our entry point was good and it's still a winner. It's not become a loser. So there is a difference between adding to your winner or adding to your loser. You know what I'm saying?
Okay, sure. Well taken. One final question, and that is from my end, really, because I had thought of asking you guys this. When we're talking about themes that could emerge really well over the next few quarters or years, if you will, I wrote a piece on it a few days back, and I have heard stories on both sides. I was wondering how you guys think about IT, simply because it's a sector that is clean and good. It's got world leaders, almost world leaders, so to say, but it's always been derided as a sector which is not innovating enough. It's not a product space, but a services space. But there are now thoughts emerging that because of the ability of the sector to deliver growth in tough times, the corporate governance, etc., valuation multiples could move up, and prices over the next 3-4 years could actually gain quite substantially. Forget the price part. Do you reckon that the sector has within itself to deliver growth in such a way that valuation multiples could move up?
I think it's possible.
Answer that?
We were actually looking at this sector in a very significant way. We've been researching it recently to get a better understanding of it. Indian IT is definitely a world-leading sector. It's a winner. It's been a winner through various cycles, and some of the large companies continue to deliver sequential growth. Which surprises people. So if you look at Infosys, look at the price. I mean, it's at a high. Of course, I think the challenge here is sometimes the management really matters in some of these companies. If you look at Infosys, all those years of pain it went through, one CEO, second CEO, third CEO. But look, ultimately they fixed it. They fixed their governance, they fixed their issues, and they seem to be on a growth path again. Again, I'm not recommending Infosys, so please don't take it as a recommendation. This is not advice. But I think that there are companies in the sector that have surprised us. There are some mid to large size companies as well, which I think continue to surprise on the earnings acceleration front. One more thing to note, these companies have extremely high pedigree of governance and separation of promoters and management. We like that. If you look in India over the last 20 years, which are the sectors, some of the large companies that have created value, many of them have professionalized. So you had promoters who gave it out to professional seasoned managers. IT was the first to do that, by the way, right? This is something to take note of, right? It happened in consumer, it happened in financial services, it's slowly happening in pharma, it's happening in specialty chemical. People are using professionals because they're smarter than the promoters. People realize that. They want to create wealth for all. IT was the first sector to do that. It continues to do that. It continues to have top tier talent. It continues to grow. So definitely, there's, who knows? I mean, valuation expansions happen over time if earnings continue, if earnings delivery continues. So that's a thought process that we share.
Okay. One final question, gentlemen. Something that we had decided we'll wrap the show with, and that is the lessons that you've drawn from the drawdowns that you've seen over the last decade or over the last 2 or 3 times that you've witnessed them. Any thoughts there? Any learnings from there?
Varun, you want to take that?
I would, my learning on the markets is I would just say a quote that markets are never wrong, opinions often are. So a lot of times, we have our own opinions and we do not trust the market. So I truly believe that. Another learning I feel is that ride your winners and sell your losers. So in every portfolio, there will be a winner and there will be a loser. Get rid of your losers first and winners later. So these are some of the takeaways which we have learned. And in money management, I would say that I think passion, process, rigor, and your style. I think if one can follow that and keep evolving, keep changing, staying humble, never get too hopeful and too fearful, staying balanced. I think some of these lessons which we have learned and we will be learning through the course of our journey.
I just one point to add to, I think, a lot of what Varun said, we have tried to document over the years. Your drawdowns are your biggest learning, your failures. It's very important through every process to understand where you went wrong and build the process. Be it simple things like sector concentration, how much of a stock you should buy, not cross a certain limit in an illiquid stock. I think all these things are processes that really need to be defined by a good fund house. So, it's not in the hands of an individual to get carried away. You can't destroy individual investor wealth because you got carried away because you had your biases. Eliminate bias through process.
Powerful line. Eliminate biases through processes. Gentlemen, both of you, thank you so much for joining us today on the first show of Alpha Moguls for this current season. It was a pleasure talking to both of you and wish you all the best for your investing journey ahead.
Thank you. Thank you for your time. Thank you for having us. Thank you. Wish you all the best. Thank you to the viewers.
Thanks, Varun. Thanks, Charandeep. Appreciate it.
Thank you so much.
And viewers, thanks for tuning in to this edition of Alpha Moguls.